All right, I think we're live. I'm going to get this started if I get the okay, and it looks like I got it. Welcome everyone to our second webinar on Central Bank Digital Currencies. My name is Ryan Todd. I'm a research analyst at The Block, which if you found your way here and don't know much about The Block, we're leading research, analysis, and news brand in the digital asset industry at large. And we look to provide insights into how this emerging industry interacts with traditional finance, technology, governments, and markets. So a couple of quick housekeeping items before we begin this discussion. We want to make this as interactive as possible. So be on the lookout. Sorry, I'm losing my voice. Be on the lookout for potential poll questions throughout the webinar. We may look to throw some of those up throughout the discussion. Also, please submit questions through the streaming service, and we'll try and leave as much time as possible at the end to get through as many of those as possible. If you can flip to the next slide. And then the next one. So this webinar is serving as a preview to the Block's release of its own central bank digital currency white paper that we're planning to release at the end of the month. And as part of that report, we've conducted a number of interviews across central banks, policymakers, researchers, tech vendors, and financial institutions. And we're really excited to share our findings with everyone here and the broader community. Some of those conversations are actually all of our panelists today we're a part of those conversations, and we're really excited to kind of highlight the conversations we've had through this medium today. Next slide. So before we start the discussion, we really just wanted to kind of give a quick intro and level set the conversation. Probably going to skip through these just to save as much time as possible, but really when we pose the question, what makes CBDC different than other forms of money? We know that it's a very broad topic. There's a lot of definitions out there. There's a lot of different motivations and considerations for why a central bank would be interested in something like this. But we really do like the Bank of England's recent definition, which buckets it really down to this. So central banks typically provide two types of money, banknotes and reserves. You can see that in the top part of this diagram, where banknotes are usually provided to everyone or universally acceptable. But the reserves are usually provided to banks and some financial institutions, so they're not universally accessible. So when you think about consumers that want to make payments, they typically use bank deposits, check accounts. And so unlike cash, a CBDC can be used to make electronic payments. It can be issued by the central bank. And then the key here is, unlike reserves, it can be used by everyone. And so that's kind of the framing that the Bank of England recently released. What's going to be interesting is, again, people have different perspectives on this, and I'm sure we'll hear about it today. But that's kind of how we're thinking about it as well. Next slide. And then if you've been following the wide array of research that's come out over even the past month, the literature is just constantly expanding on central bank digital currencies. It feels like you can't go another week without another report being published. And the common stat that gets thrown out by the Bank of International Settlement, BIS, is that more than 80% of central banks worldwide are engaged with either research or testing pilots around central bank digital currencies. A lot of this work is mixed based on use cases. So both retail and wholesale applications. I think for the purpose of this conversation today, we're really going to hone in on the retail use case. And if you go to the next slide. One other quick thing to point out before we begin, and why we think it's the right time to have this conversation, is we've seen recently into 2020, a pretty significant shift in central bank not only interest, but just positive stance on retail central bank digital currencies. The BIS kind of covers this in one of their latest reports back in March. And then we've also now are starting to see a handful of banks move into pilot phases and testing implementations and various design questions around what a retail CBDC looks like. So with that, I'm going to pass this to Mike, and he's going to get the conversation started.
First and foremost, we would like to thank our sponsors, KPMG and Blockset, for commissioning this research and the report that Ryan and I have been working on for the past 2 months. We really have gotten so deep into this topic, and as Ryan has said, it seems like every other day there's new reports coming out, and that's actually where, when we've been interviewing experts within the field over the past couple months, we really enjoyed the responses that we got from Sheila, John, Carmelle, and Bob. So we figured that it would be great to have them, put on this panel for you, the audience, and we really would like to hear and get real-time feedback on what everybody is really wondering. So I'll start off with each one of them and ask some individual questions, and then the last 5 to 10 minutes, we hope that some of the questions that everybody puts within the queue we could get to. So first off, we have Sheila Warren from the World Economic Forum. And Sheila, thank you for joining us. We have a deceptively simple question for you to get started. What are central bank digital currencies, and how do they differ from digital and cryptocurrencies?
Yeah. Hey, Mike. Thanks. Good morning. Thanks for asking. I agree. I think this is a deceptively simple question, and it's an area where there is some confusion at kind of the most basic level. I hear a lot of people say a CBDC is like fiat. It's like fiat money, and the answer, that's actually not correct. It is fiat money in the standpoint. It's a digital form of sovereign currency. So the same way that paper cash, or coins are held, created, and issued by and a liability of the country's central bank or monetary authority, similarly, CBDC is a digitized version of that same concept. It differs, I think, and I think the interesting area is kind of where it differs from other digital currencies, more generally speaking. These are usually categorized into 2 buckets: stablecoin and cryptocurrency. And the distinction there, just to kind of be complete, is that those are not issued by central banks or monetary authorities. They're not legal tender. And they often have, they can be extrinsically backed. So stablecoin is often backed by fiat or a basket of fiat currencies, whereas cryptocurrency is not so backed. It has its own value that is determined by its own systems. And the last thing I'll note, just to kind of round out a definition, is that there's also a misconception that a CBDC necessitates the use of a particular technical backend or a particular technology. That's actually not true. You can have centralized CBDCs or you can have decentralized CBDCs. Those can sit upon either centralized or decentralized technology systems. That doesn't change the nature of the issuance of the CBDC. It's just the technological choice that goes into that. But that is not part of the definition of a CBDC. It's merely the implementation mechanism that's chosen with the technology. And there are very good reasons why you might go one way or the other when you're making that choice.
Fantastic. Thank you, Sheila. And to get further into the specifics of central bank digital currency categorization, we'll speak to John Kiff from the International Monetary Fund. John, thank you for joining us again. Can you explain for our viewers what the difference between wholesale and retail CBDC is, as well as account-based and token-based CBDCs? Because that seems to be the standardization metric that most have used in the earlier days.
Sure. Thanks, Mike. Well, first of all, wholesale versus retail. I think in a way Sheila's already defined that. It was defined also in Ryan's little money flower there too. A retail CBDC is widely accessible and it's meant for use by the general public. Wholesale CBDC is a different beast altogether, really. It's limited to a set of predefined user groups, typically banks and other members of the national payment system. So in Ryan's money flower, that would be what he called reserves. Mm-hmm. So that's an easy question. The second one's actually not so easy because there's a lot of confusion around this whole token versus account basis paradigm. And in fact, we, along with many other central banks, are trying to veer away from that paradigm, really. So, because in terms of the conventional account versus token basis paradigm, account-based payments, they're basically transfers of claims recorded on an account, and there's a centralized ledger, or maybe it's decentralized. And the token basis is where the payments involve a transfer of an object, like a dollar bill or a coin or something like that, or a digital version of that. But there's a lot of gray zones in there, so we've preferred actually to go with a different differentiation where we basically have ledger-based versus non-ledger-based platforms. And so within ledger-based, you have a whole bunch of different nuances. And just to step back for a minute, the reason why we don't like account-based versus token-based is that some economists will put, say, the distributed ledger technology type of system they put in the token basis, and yet that's probably a flawed paradigm, because even something like Bitcoin or whatever, it's distributed ledger technology, but it does evolve a ledger as an account. It's just the account is managed in a different way. It's managed on a decentralized basis. So what we like is to first of all start with a ledger-based platforms, and then from there differentiate who has the authority to verify and commit transactions to the ledger. So in a traditionalized centralized ledger, where you have client-server model with no distributed components, transaction processing entails the payer connection to the central ledger keeper, initiating the funds transfer to the recipient's account, and then the account keeper looks after all that, or the account keeping system in the case of a distributed decentralized authority model, like a DLT type of model. So then in fact most of these DLT-based CBDC experiments that we've been focusing on and seeing in the wild recently are based on private permissioned platforms, which are kind of rather centralized anyways. So that's the ledger basis world, and there's pros and cons to each of the different flavors of these ledger-based platforms. The BIS paper that was released a couple of months ago has some really nice analysis of the different flavors of these ledger-based platforms. And now the ledgerless platforms, now that's what I call, this is the true, real token basis platform. So they can conduct all the transactions peer-to-peer, offline. So they're identical to having cash. There's no tracking of transactions or anything, and they would typically be mobilized via stored value cards or in a mobile wallet app, in which the prepaid values are stored locally. And no one's really looking closely at that yet, but some central banks are kicking the tires on such a token-based platform, and they would probably be of most interest to countries where large parts of the population are excluded from the financial sector, so they can't connect up to bank accounts or whatever, or they don't have any internet access at all, so they're living in very remote areas. But again, these, in terms of the efficiency of one versus the other, it's really, there's no one single answer to that. The pros and cons to all of them are here and there, and they depend on the country's specific circumstances.
For sure. Thank you so much, John, for that detailed answer. I mean, you come from a convergence of many different backgrounds, and I know you started out in economics at the IMF, and you've really been getting pretty deep into this topic. And John and the IMF just released a paper recently on really goes extensively into CBDCs. So really, I recommend reading that for everybody. So specifically getting into the actual nitty-gritty of a service provider standpoint, we have Carmelle Cadet from EMTECH, and we would like her to start out by speaking and telling the audience about the Zandalar project that's going on in Bahamas. Hi, Carmelle. Thank you for joining us.
Yeah, sure. No, thank you for having us. It is a good time to be talking about CBDC. Ironically, it's It is 1 year to the date officially that EMTECH one full day in business, and we actually launched to talk about and build an infrastructure for CBDC. So we never thought that this would accelerate so much, but we're not complaining. But the project in Bahamas, Project Zandalar, was the initial project that we are still participating in. And let me start by saying at least the backstory on what led this project and how we got involved. It really started with the Central Bank of the Bahamas and the government establishing a vision of modernization of payment systems for the country. For a lot of emerging markets, they are really struggling with international standards, with financial inclusion issues. And one of my personal beliefs, which really got me excited with the Bahamas, is that when you take a step back after a few years of us talking about the unbanked populations, whether it is in the US, which is actually pretty significant as far as actual numbers, but even in emerging markets, to say, what is a model and what is the role of the central bank in answering that gap? Because if we are honest, the banking model is a commercial model, and I started my job as a teller, so I won't be bashing banks. I love banks. But the idea is we can be also honest that it has its limits because of the commercial model and the structure that it has. Therefore, the central banks have a different appeal as far as a public good and the provider of infrastructure. So a light bulb went on at some point and said, okay, that gap is going to have to be filled by the central bank. So then you say, well, central banks cannot, open individual accounts. They can't manage that. They don't have the infrastructure to, engage at that level, do KYC. And then there's a reputational risk component of it as well that comes in, that central banks have to distance themselves and also play the role as the independent regulator. So blockchain introduced a central bank digital currency. At the time, even if we didn't know it, we knew that the central bank was responsible for providing the infrastructure. What I think Project Zandalar shows is, one, with leadership. From a central bank governor, I think that the governor role deserves a lot of credit for leading and taking the effort and being the first one and not saying, we'll wait and see. This is the actual first live real CBDC and done in a very thoughtful way to say we have a use case that we're trying to solve. That was the initial scope that was defined when it comes to financial inclusion. And I think for any country, and based on the examples that we're seeing, if you were to say how to CBDC, starting from a use case perspective is very important. Understanding what problem that you want to solve makes it much, much easier to start somewhere. And the initial layer of CBDC, as Sheila mentioned, as far as the fiat and the paper cash, that is the most native or the lowest layer of money that you can think of, and that is the infrastructure. From there, it takes different forms. So introducing that digital cash, that sovereign layer of cash for the unbanked proved that you don't have to disintermediate banks, but you also can provide financial inclusion. So shout out to the technical partners, Enzia, who are building kind of an amazing infrastructure when we think about the internet and the communication layer that needs to go into certain market for blockchain and CBDC to be realistic. They are a really good player that's building and showing a blueprint in the Bahamas right now.
Thank you so much, Carmelle. I agree with everything that you said. Actually, for everybody, we really would highly recommend checking out the Zandalar. It takes up 11 pages of our report, and it's actually one of the highlights that we have because it's actually in a pilot stage and it's being implemented. And that's for emerging market economies, which if everybody were to check out Sheila Warren and the WEF's the CBDC policymaker toolkit, you would really see that emerging market economies are a big piece of this. But now let's transition over to developed economies, specifically the reserve currency developed economy. With us to discuss that is Robert Ben from the Boston Fed. Thank you for joining us, Bob. So where does the U.S. Fall within this CBDC spectrum? I think that's what most of our audience members are here for.
Well, thank you for having me, Mike, and it's great to be amongst this panel. I think the question is where we fall is, we're a lot like our friends to the north in Canada, whereby we understand that there is a lot happening on the technology front that could aid the mission of the Federal Reserve. And also, we are learning from the rest of the world that problems can arise or challenges can arise that would need the Federal Reserve to respond potentially with new technology and potentially with a central bank digital currency. Like Canada, we have no plans to issue one. But we better be ready if one of those events emerge that we have seen in the world that could require us to take action. And furthermore, our division in Boston, in the Federal Reserve Bank of Boston, is exclusively a technology division. We are not policymakers. But I'm sure, like our friends in Canada, and our friends in the ECB, or our friends in China, there is a lot of levers we need to understand how to pull, and what happens when you pull 1, 2, or 3 levers. That's critical for us, and that's always also based on the problem you're trying to solve. So if you look at the scope of our friends throughout the world, Sweden had a challenge where cash became less useful. So they had to build a model that was effectively a cash replacement. Our friends in the Eastern Caribbean Central Bank, they were looking at a situation where to move any form of currency, it took a fixed $100 fee because the dozens of islands that exist in the Eastern Caribbean. So what they had to do was build a system that was cheaper than $100 per transaction, faster than a boat or a plane. So every use case is dependent upon the central bank builder. So on behalf of the Federal Reserve side, we are trying to look to the future to understand what use cases that could emerge, that could lead the executive and legislative branches to have this action occur and to be prepared for them, and to effectively communicate to the policymakers what the trade-offs are. That's the key question for our division, is deeply understanding the technology and to clearly detail the trade-offs of every policy decision that could be made.
Thank you so much, Bob. Yeah, I couldn't agree more. I mean, we need to break the glass plan just in case, but really, you need to. This is such a tremendous undertaking. I don't think that people really truly understand what this entails and how many different systems, from the payment system to the overall financial system, are intertwined within something like this. So I guess that would be a great way to transition over to Sheila. And Sheila, you got together a bunch of the heads of central banks under the World Economic Forum Global Consortium for Digital Currency Governance, and you came up with the Presidio Principles, no longer the Blockchain Bill of Rights. But can you discuss how, why did you get everybody together for this, and how does it relate to central bank digital currencies?
Yeah, thanks, Mike. You're talking about 2 distinct things. So our Presidio Principles are actually output of our Global Blockchain Council. And that group reflects a number of different blockchain experts across the spectrum. So those who are everything from Bitcoin maximalists to blockchain skeptics. Central banks are represented in that group, but it's not exclusive to them by any means. And they are just one part of a much bigger group there. The Digital Currency Governance Consortium is focused on digital currencies. So there we do have some blockchain experts and those who are quite convinced that DLT is necessary for an issuance of a digital currency, or a CBDC for that matter. We're not looking just at CBDC there. And that work represents, we've got banks, policymakers, civil society organizations, academics, a whole bunch of people coming together. So that group is the next phase, if you will, of the CBDC Policymakers Toolkit work, which we launched in January. That group, to kind of lay this all out, was comprised of central bank technologists. And we created a community in part for some of the reasons we've been describing here already, Carmelle and Bob have noted, which is that what we were observing was that a lot of the real innovation, to be quite frank, was happening in emerging frontier economies. And the more developed economies were looking at really pretty much one use case, interbank settlement payments. And they were looking at that in very different ways. It was very interesting, but it was a very narrow use case for the reasons that Bob mentioned. That was the relevant use case for those economies. What we wanted to do was really connect those groups and say, listen, you might be looking at this right now in this context, but there are a lot of other people who are doing deep examination of other use cases that you should be aware of because they all inform each other, and they're helping to move the technology forward. So we got the group together just as almost a community to just kind of share learning and experience. We were able to connect them with technical experts, some of the major startups, some of the academic experts. They were really looking for people to educate them who weren't trying to sell. And recall at this time, we're talking 2018, everybody was in sell mode. So we were able to connect them with neutral experts who didn't have skin in the game in that way, who really wanted to just talk deeply about the technology and what it could and couldn't do. So from there, we got demand signal from that group that for their policymaker side, for that counterpart, what they wanted to do was ensure that there was the ability to educate the policymaker side about where DLT was useful and where it wasn't useful. And that's what emerged, the policymakers toolkit emerged from that. The next phase is looking at digital currencies more broadly, stablecoin, even crypto to some extent, and thinking about what is the governance mechanism that could underlie those issuances that might support a more global orientation toward that particular category.
Yes, it's not just about the technology, it's about governance and economics too, which is something that not many people really realize with this. Now going more into an economics theory and idea, John, can you, this is something that we found through a lot of our research. We went down a lot of the footnote rabbit holes, and it looks like academics and economists have been discussing what would be expanding access to the central bank balance sheet, and a lot of that comes in with retail CBDCs and whether it be account or token based, and having so many different people have access to it, because traditionally it's been banks, and more recently, it looks like some central banks have allowed payment, technology payment service providers to have access. Most recently, I think it was the Bank of England. So let's talk about access to the central bank balance sheet and what that entails. And it seems like we've had a lot of academic theories about it, and have we just been waiting for the technology to kind of catch up and make it feasible?
I think the answer to that one's sort of one of those yes or no type of answers, because like you say, the academics have been talking about this idea. I think going back to the 60s. I think Milton Friedman is one of the famous economists who is a proponent of this idea potentially. But I think the technology has been there all along in the form of the same technology that commercial banks have been using for ages. So potentially in a very simple CBDC platform, central banks could just basically jump in and offer their same services as commercial banks. And for some countries, particularly those with underdeveloped financial sectors, maybe that's the way to go. We may get a chance to talk a bit more about these different business models later. But I think what has changed, and this is the sort of the yes part of it, new technologies like application program interfaces, the APIs, and distributed ledger technology have opened up new ways of central banks to operate with the private sector to offer CBDC. And I think what may have changed, if anything, is that it's more like the motivation side of things have changed. And when we scan the CBD commercial banks for the kind of motivations that are driving the new interest in CBDC, we look at things like the fact that in some economies, Sweden's one of them, cash is being driven into a corner, and payment services are being dominated by private sector payment services. In the case of Sweden, it's something like 80 or 90% is controlled by one single institution that actually is at risk of moving the control of that payment system outside the country. So in that case, they and some other central banks are looking at CBDC to basically solve what we call monopoly distortion problems. Because if a payment system has a monopoly, there's a possibility that it could use that monopoly power by offering expensive or not inadequate services. You also have single point of failure issues that you may not be able to regulate away, because you just got one big mega institution controlling all of the payment services. Also, the new threat seems to be Libra. We will often say reducing or preventing the adoption of privately issued currencies. That's what we say amongst ourselves in the official community. But really, Libra has kind of been a bit of a shock for many that's got them got central banks thinking about offering a competing service. And also just the fact that some central banks are looking at CBDC to improve monetary policy effectiveness. We don't talk much about or anything at all about design features in CBDC, but you could have a CBDC that bears interest, a variable interest rate that could actually be used to work with an enhanced monetary policy effectiveness. And in other cases, the more recent one that we've seen in the U.S., the potential for using CBDC as a way to distribute fiscal stimulus to people that are not banked or serviced by the conventional private sector. So, that, like I say, it's a kind of a yes and no answer to whether this is the new technologies of whether CBD's been waiting for a new technology. I'd say that's yes and no.
Great. Yeah, there's always a lot of gray areas. So I would say you touched on API standards, and a lot of this specifically with getting stimulus to individuals has to do with infrastructure. And I can think of a better person to ask about infrastructure and API standards than somebody that's actually implementing the CBDC service and putting out all the rails and pipelines that we need right now. So Carmelle, can you comment on that for us?
Yeah, definitely have a roadmap on that. But the API transformation and the open banking model is something that I think is going to be very interesting in the US. It's not here yet. But I travel the world, and there are different stages of APIs, right? I mean, if you go to Singapore, for example, with MAS, with the APIX platform, that is a private-public collaboration that really shows how you can essentially expand on innovation and APIs to do that. But yes, we are a big believer in the paper that we published for Project New Dawn. We talked about a digital cash infrastructure, and that's the way we think about it, that essentially has three components, which is the digital cash blockchain itself, which is, the token engine, the governance mechanism, and the architecture that the concept that we have put forward is essentially what is in the US today, where you have the Federal Reserve with the 12 regional banks as the initial node manager, and eventually having also bank integrations for settlement. So imagine your Fed account being a Fed wallet. So those are the type of ideas as far as coupling the current system to something new. The second layer of that digital cash infrastructure is the API access platform, right? So there's a lot you can do with the token. How do you do it, and how do you separate privacy, the client's, the user's app, the user's information from the blockchain itself, but allowing that communication to be trusted and the endpoints to communicate well and execute as desired, the limits that the central banks might want to implement with the wallets, for example. So John mentioned the interest-bearing CBDC. That is one key factor that we see is a big lever that central banks will have to thread carefully, depending on their markets and depending on how much they want to take on. But being able to provide a cash-like model, CBDC, that model itself that really replicates cash, having an API platform that allows people, imagine what you do with cash today. There's definitely no one way of coding that, right? Whether you wanted to exchange your digital cash with Bitcoin, the way you do your bank deposits today, that's going to require a different API. If you want to transfer your cash into your normal bank account at TD Bank, that's a different integration. So APIs, honestly, this is where we think blockchain is going to become consumable, is via APIs. One goal that we have for EOC over the next few months is that when we deliver, the user itself, we have two audiences, right? We have the regulator, maybe you, John. We have the regulator and on one side, and then we have the user on the other side. You should not even know that you're using a blockchain, right? It shouldn't matter. It's really about the benefits. So can the central bank make a decision on, okay, we're going to accept digital wallets for the extra 35 million checks that have not been issued for stimulus, and allow people to go on a website and download a wallet and do their social security verification, do their driver's license number, and being able to get benefits right away. So that's the level in which we want to talk about this, and we can really do that. Yeah.
Great, thank you so much, Carmelle. That was very detailed, and a lot of things that you discussed, specifically the limits with wallets. We detail that within the Bahamas section of our paper, and that'll be important for the next question that I'm going to ask John when it comes to bank runs and stuff like that. But before we do, let's get back to Bob from the Boston Fed. So Bob, from the U.S. standpoint, who would be the users for potential CBDC? Would it be banks? Would it be citizens? Would it be both? And who would actually be operating the infrastructure itself? Would it be the banks, the central banks, collaboration between public-private, maybe the technology service providers? I think most people would probably benefit by understanding the two-tier financial system that is currently in place in the U.S.
Yeah, I guess what I'll first say is that I'm speaking on behalf of myself and not the Federal Reserve Bank of Boston or the Federal Reserve Board of Governors. But we think about these things a lot, and there's a lot of trade-offs. Again, we're always thinking about trade-offs and cost benefit to what model you use. So I think your first question was, who are the users? Again, that goes back to what are you trying to build? If you're building a wholesale CBDC that's focused on solving capital markets questions, right, with mostly cash settlement and cash payment, you're going to have users that are banks, right? Banks and asset managers and those who participate in capital markets. And the build model you're looking at has to be tailored to that banking model. So you're mostly focused on interoperability, you're focused on throughput, but mostly you're trying to work with your banking partners to understand how do you integrate best into their tech stack, the common tech stacks of the banking partners, right? If a wholesale CBDC is built by any government that's focused on capital markets, it has to work within the capital markets participants environment. And that takes time. Changing a banking technology environment is very difficult and timely. I've worked in the commercial banking sector. It is not an easy process. There's a lot of stakeholders involved. On the other side, you have the retail, which is an entirely different environment with an entirely different set of questions. Now, you can build a single type of CBDC that solves both their problems, but that build's going to be complex. With retail users, you have to think about their concerns and the problem you're trying to solve. If you're trying to solve accessibility questions, well, then you need to understand how will they access this? Is it a smartphone or feature phone? Does it have to work with both? If you, as John noted, if you're in a country that has sometimes poor internet access, are you gonna have to think about near-field communications and certain credit limitations or credit maximizations based on that near-field communication. This came up in Congress last week when a gentleman, representative from Montana, asked, there isn't great cell service in Montana, how will this work for us? And as a designer of a CBDC in a country that has those spots of lacking Wi-Fi or lacking web internet access, you have to think about that. You have to think about speed, right? If someone's going to use a retail CBDC as opposed to a credit card, it better be as fast as the card networks, at least on a cost basis. In the card networks, you got to think in the hundreds of thousands of transactions a second to be viable as an alternative. That's not easy to do, and there's trade-offs there if you want to make something in the hundreds of thousands of seconds. If you want to future-proof something and you're thinking about Internet of Things payments, where you know, in the Amazon store, when you walk directly in, they automatically pay for you. Once Internet of Things, if devices start talking to each other, you're really increasing the payment speeds. So then you're thinking about in the millions of transactions a second, and what platform is capable of doing that. And then on top of that, you have what I think are the two most critical questions for retail CBDCs. One is security. A retail CBDC, particularly a reserve currency retail CBDC, can and must not operate off the ground unless it's entirely secure or at the highest levels of cybersecurity. And that is very hard to do, particularly with the next question, which is privacy. Depending on what privacy functions you decide to put into place, layering privacy and security is very difficult, and it's a very complex technology question. And that's a question that does not really have to be addressed by the wholesale banking sector if you're building a wholesale CBDC or a capital markets-based CBDC, which makes these conversations very difficult to have in tandem. So, what we look at is, what are the trade-offs between, transactions per second, or throughput, against security, right? We think security and speed are the two biggies, right? this thing better be really safe, and this thing better be able to compete with existing financial networks. But then you have to layer on accessibility and privacy. Depending on what country you represent and what country you come from, privacy means very different things. And again, so you're thinking about what is best for your country, what is the problem you're trying to solve, and depending on how your country views privacy, that can be a very complex question that must involve a lot of stakeholders and a lot of careful thought.
Great, thank you so much, Bob. That was articulate, and really, there's so many different considerations that go into this. Specifically from a policy standpoint, I could only imagine. But what's great is that we actually have Sheila from the World Economic Forum and their policymaker toolkit that her and Ashley and the rest of the World Economic Forum team, they put together a fantastic toolkit. It took them, I think, over 5 months to do, and it had so many different. It's like a detailed, go this way, that way, answer this, if doing that. It's like it's a decision tree basically. Can you speak more about the toolkit, because it really is great for people to look at?
Yeah, well, thanks, Mike. I appreciate that. Just to kind of get back to Bob's point, though, we used to joke like 2 years ago, it was kind of like, safe, fast, and private, pick half of one. You know what I mean? And now it's like, maybe you can get one. We're getting there, I think. And I'm certainly optimistic about the ability to kind of balance some of the considerations that Bob noted. But what our policymakers toolkit does, so it's related to the community I discussed previously, which was comprised of around 45 different institutions, a bunch of central banks from different geographies with different considerations, and then also IMF, World Bank, like other kinds of major players that set policy and that help think about this topic. And so again, it was a response to demand signal from technologists of what were the considerations? How do we kind of provide this objective analytical model for how to think about whether or not to implement a CBDC. And so we kind of point out these areas of friction. It is certainly meant, I think, to everyone's kind of previous comments, to accompany the very specific analysis done by a central bank of its context. Because I think, as many of my colleagues here have noted, that those differ quite widely depending on what, and even within a context, you might be looking to solve a different problem. You might have the same problems, but you might be focused on those. And what you're putting, how you're prioritizing what you're trying to solve is going to really, obviously, as it always should, really determine what considerations you put, at the top of your list in terms of priorities, and which ones maybe are not quite as important. So we try to really articulate a lot of this, and it is intended to be a model that is quite comprehensive in terms of, who needs to be part of this decision. There's a tendency, I think, in some central banks, and this is not true universally, for the technologists to kind of go into a silo and think of their ideal solution, and then the policymakers think about their ideal solution, and there's not necessarily a ton of cross-pollination. And what we're trying to engender is to say, really all the parts of the house. This is a holistic consideration. It is not strictly a technical, decision. It is not strictly a policy decision. And from that matter, it's not just about certain parts of the policy house. It has to take into consideration all of these different factors. So that's what we try to lay out. And I certainly welcome, it's publicly available. We certainly intend it to be a resource. We've had many central banks reach out to us and kind of ask the questions about certain kinds of things here and there, which we're happy to address from that community specifically. And yeah, our hope overall was to just remove some of the fear out of this discussion and to lay out that there are very good reasons to do this, to do it in certain ways, and there are very good reasons not to do this. And it's just a matter of assessing what is right for a particular economy.
Great, thank you so much, Sheila. You mentioned fear and frictions, and there are two things that I know that John, from our discussions, you wanted to discuss. One was privacy, and the other was the potential fear or concern about bank runs that people might have with a retail CBDC. What are your thoughts on privacy and that other potential consideration?
Well, yeah, definitely privacy is an important part to build into the design features. And I'm not going to go too deeply into that, just to say that that's a very complex trade-off that we deal with deeply in our in this paper that you mentioned that we published. But you bring up this problem, what we call disintermediation, that if you build a CBDC that's too attractive, it'll suck deposits out of banks. What are we going to do about that? Well, definitely it is a concern. Although we believe that most, if not all, of this disintermediation risk can be mitigated with smart design choices. Yeah. So first, let's start with the question of interest bearing. If you make it interest bearing, that's one of your toggles basically to control potential disintermediation, because obviously if you make this interest bearing, you make the rate too high, you will definitely have some issues with sucking deposits out of the commercial banks. But actually, I think as others have said, that the interest bearing aspect of CBDC is something that academics have liked to talk about, but no one that I know is actually implementing interest on CBDC. So we mainly make sure that it's like as much like cash as possible, although we advocate kind of future proofing the design of the CBDC so that you have that option in the future to have an interest rate on it if you decide that's a good idea. But the other way you can control for disintermediation, and I really do like the Bahamas Zandalar way of dealing with this. It's applying smart limits to the holdings of the CBDC. So in the case of the Zandalar holders with bank accounts, their wallets are linked to those bank accounts, so that if the CBDC holdings get too high, they get siphoned off into the bank accounts. That's, we think, is a very good design feature. And then for the unbanked, there's a wallet with very limited size of holdings. And also, although it's not strictly a CBDC design feature, it's helpful to have credible deposit insurance in place. That should mitigate disintermediation, and particularly it'll mitigate run risk, because if you have credible deposit insurance in place, if you have uncertainties about the health of the bank where you're holding your deposits,
looks like John might have just cut out there. So that would be a good time just to transition over to Carmelle quickly. We have about almost 12 minutes left.
Mitigating that.
We have John. You're cutting out a little bit over there. So we're going to go to Carmelle quickly. So basically, Carmelle, John did touch on the Zandalar, and particularly, can you speak about the Zandalar? How about a sandbox, regulatory sandbox?
Yeah.
And how is that helpful with the implementation?
Zandalar, Sandbox, we all wish we were by the sand right now, that's for sure. So the idea of a sandbox for us came from our conversations from various central banks. I hit the road around this time. Actually, last year I was in Kenya around this time, talking to central banks, and and I tell this story all the time. We say Central Bank Digital Currency, and they said Sandbox. Central Bank Digital Currency, it said Sandbox. I said, what is this? But when we started looking at it, the shift that needs to happen for a lot of central banks to get to Central Bank Digital Currency, and like Bob said, is trying to wrap their minds around the implications of this. And we realize that a lot of countries, they cannot make that leap without a structure. And especially from a central bank perspective, when you think about the type of organization, they are conservative for good reasons. A lot of the regulations sometimes are reactive, people would argue, out of lack of knowledge and education and capacity that needs to build, especially when you have something like Bitcoin, like blockchain, and all of a sudden you hear Libra, and then everyone is talking to central banks saying you need to do something. It's difficult. So the sandbox idea for us is not only what people are used to from a regulatory perspective, to ask fintechs and innovators to come and get approvals, but it's also what we call a modernization of a central bank to also leverage a sandbox mechanism to introduce innovation to the market. So while keeping your market stable, while not launching products live, if a central bank wanted to test their CBDCs, we think a sandbox is the way to do it. It can be controlled. You can invite either banks and innovators. We highly recommend that innovation, embracing innovation at the central bank level. Sandbox is a way to do it, to bring innovators to the table. As Bob mentioned, there are priorities and there are challenges that the central banks are trying to solve for. They are technically on the hook to solve for that. But they don't have the mechanism or the infrastructure to execute fast enough or effectively enough. So bringing and prioritizing national challenges is something that a Sandbox can help a central bank do. So we call it a collaboration and innovation platform where innovators and regulators go and create great things together. So we think every central bank that's going to introduce a CBDC should have a Sandbox strategy.
Sounds like fun. And with the last question, and then we have 8 minutes left, and then we'll go rapid fire through the audience questions. So, Bob, I wouldn't be able to myself if I didn't ask you this question. So, what the digital dollar project? That's something that everybody within the U.S. is talking about. Can you talk more about that? And what are your personal thoughts, not the Fed's thoughts?
My personal thoughts are: anytime you have a group of smart people willing to try to solve a problem or bring about public change, that's good, right? Smart people being involved in the country is a good thing. And I think one thing to give credit to the people running the Digital Dollar Project is they've brought together a fairly diverse and inclusionary group of voices to understand what type of requirements could be out there that folks like myself might not be thinking of, and to help bring those voices to the table. And it's not just the Digital Dollar Project, right? There are a lot of very smart people thinking about this broadly, including, for example, the DCI at MIT, right? They've been working on this for 5 years with folks like Rob Ali and Neha Narula, who have been thinking about this deeply from not only a technical standpoint, but from a central banker standpoint. So we're positive, in the sense that we want people working on our problems. We want people asking these questions, and we want a lot of voices at the table. I think the most important thing for us as we try to understand this contingency planning idea and to understand the trade-offs is to talk with people who have thought about this before, who have done this before in some way, and understand what worked and what didn't, right? I'm a big fan of Edison's theory of he failed 2,000 times, right? He never didn't fail, I should say, didn't fail 2,000 times. He learned 2,000 ways something didn't work. But what he really did is he learned 2,000 different trade-offs, right? And we need to talk to people like the Digital Dollar Project. We need to talk to universities like Stanford and MIT. We need to talk to the crypto community. We need to talk to the traditional banking community. We need to talk to people who create relational databases like Oracle, right? We need to understand all the trade-off these people know, because the Federal Reserve is good at a couple things. We're really good at a couple things, and we have the best and the brightest in the world on a couple things. But we don't cover the entire remit. And so the best thing we can do is learn. And the Digital Dollar Project is one great example of people focusing on solving a problem or making something public better. And we enjoy talking with them.
Great, fantastic, thank you. So rapid fire, we have 5 minutes left, guys. We got to get to the audience questions and responses. Keep them brief, please. So Sheila, one question is, where does the UN fit in all of this, particularly with cross-border transactions?
Oh, interesting question. They do have a crypto fund they're looking at. I think they're paying very close attention to this. From the standpoint of, do we expect them to come out with some, major statements? I think it's a different body with a different purpose, and I think they're looking to some of the groups that are really deeply involved in this space to help inform them. But I've been very surprised by the different actors that have chosen to engage deeply in this topic, and so my hope is that really any international organization with the breadth and depth of mandate that the UN has will get even more involved in the work than they already have been to date.
Great. So Pedro C asked for John, any pilots of hybrid CBDC yet?
Hybrid, this being what we may call the synthetic CBDC, I believe, right? Is that what is intended by that question, do you think?
I believe, yeah.
Because
I believe so, yes.
There are some that look like that. For instance, in China, the WeChat Pay and Alipay are required to hold their reserves at the PBOC, the People's Bank of China. So in a way, that's kind of a tiptoe into that hybrid synthetic CBDC world. I believe also, I think it was mentioned earlier, the Bank of England has opened up its balance sheet for, I don't think anybody's taken advantage of that yet, but that's sort of semi-launched. I believe some Central American countries have also launched e-money operations where the operators keep their back-end funds at the Central Bank.
Great, thanks, John. Carmelle, this one for you. Somebody said if you have to present a driver's license to get Sandalars, then how are they like cash? How is it different from, say, M-Pesa?
You don't have to present a driver's license and Sandallar. The governor actually held a press conference when we were doing the pilot down there in December, and his line was very simple: if you can hold cash today, you can hold $10. The limits are how you get to kind of risk-based models, and those are very important. And I think as every economy, and as the U.S. also considers whether it is a digital cash layer that the U.S. ends up introducing for the unbanked population, that's a use case I'd love to discuss. And the idea is to say, how do you bypass some of the barriers, some of the KYC barriers in some markets, to be able to still give someone access to digital finance. And then from there, ironically, you also bring them into you include them in the digital transformation that can actually allow them to build a profile and a KYC and an identity in a way that's beneficial and can end up being very valuable for them to access more financial services in the future.
Great. And this next one is from Okiki for Bob. Is there an argument that instead of weakening the benefits of using and holding CBDCs, banks could instead make their offerings more palatable and enticing? If so, what would weaken that argument?
Sandbox.
Can you say that again? I lost you for a moment.
Yeah. Is there an argument that instead of weakening the benefits of using and holding CBDCs, banks could instead make their offerings more palatable and enticing? If so, what would weaken that argument?
It's a great question. We have, and I think I know who's asking the question. It's a former colleague of mine, who's now at KPMG. Thanks for the question, George. I think, as far as the central bank is concerned, or my division is concerned, we're not necessarily worried about bank integration. We're worried about what are the trade-offs that would best serve whatever problems could come to our fore that we have to solve for. I think the most important thing for our banking partners or for the Federal Reserve is to understand what is the impact of what we're building on the banking sector. They play a key role, particularly in credit formation. So, as John noted, we need to make sure whatever we're building does not cause outsized risk to our banking partners, in the sense of credit formation and the ability for them to create money in their own way. So it's a really tight balancing act. But as we start exploring these trade-offs, not just technology trade-offs, but we need to work with the economists of the Federal Reserve who really understand what these trade-offs look like from economic standpoints. And I'm sure folks like John at the Bank of Canada and the IMF are doing this as well. And this is one of the harder questions that we have to answer for. But again, at the end of the day, it comes to what are our goals of the Federal Reserve, which is making our money accessible, right? It's making it efficient, and it's making it secure. And we think we can do that working with the banks. And so I think the key for us is to work more closely with our economists and our banking partners to understand how to build that.
Great, fantastic. Well, that's a great place to end it. We want to thank our sponsors again, KPMG and Blockset. Thank you to our panelists. You guys were all fantastic and brought a lot of diverse experience and points of view to this discussion. That's very important. And thank you to everybody who attended in the audience. If those other questions, we'll keep note of them, and hopefully we can address them, and be on the lookout for the replay. But thank you again, everybody, for attending.
Thank you.
We really appreciate it.
Thanks, Mike.
Yeah.
Thanks, Mike.